So we're still positive on emerging markets for this year. It's been quite a tough start to the year generally for risk assets. We've seen interest expectations change a bit. We have to put it into perspective that November and December were incredibly good markets for risk. Both emerging markets and developed markets did very well, but probably the market has over-anticipated how many rate cuts are going to be. And the data this recently has been stronger. So the likelihood of interest rates cuts being deeper has diminished. But we are positive on emerging markets this year. We were expecting this volatility. Three reasons that we're really looking at the moment. Firstly, emerging markets benefit when interest rates come down. And particularly areas like Latin America should really benefit from the end of the US monetary tightening cycle and rates coming down over the next year or so. Within that, the dollar is very, very important. And a lot of asset allocators really look at the dollar as being one of the key things of why they buy emerging markets. And as rates come down in the US, the dollar should stabilize, shouldn't be as strong, and potentially should weaken against certain other emerging markets. So for instance, in Latin America, we're very positive from a sort of country basis that rates will come down, the currency will pick up, and that should give very good returns for investors. The second point is that developed market growth is slowing, but emerging market growth is accelerating. And the reason is simply that emerging markets and Asia came out of COVID later than developed markets. And the consumer, the retail investor, the average person wasn't given any help. Where in developed markets, checks were written, people who were out of work were given money, and the government did everything it could in the US, in Europe, and in the UK to keep consumption going, to keep the demand there. But in Asia and emerging markets, it was a different story. The government didn't do that, and the demand has fallen. And so the demand recovery will be slower, and we're now beginning to see that benefit. So as the economy picks up, as employment picks up, as wage growth picks up, then consumption picks up. And that's something that I think will really surprise people this year. Thirdly, China has been out of favor. The economy's been weak. Investors have avoided it. But we do think that at some stage we will get a pickup in China. The economic news is not as bad as the stock market's pricing. It lacks a catalyst, but we do expect within the second or third quarter that earnings will bottom in China, and that we'll start to see more progression in earnings, so better opportunities. And we're left with a very cheap market and a market which is very under-owned. So we're quite positive. One risk we have to be aware of in emerging markets this year is political elections. Obviously, everyone knows about the US election, but in emerging markets itself, we've got an election in India, in Mexico, in South Africa. We've just had one in Taiwan. So we have to be very careful with that. Sometimes that gives us a great opportunity to add to areas and add to stocks in those markets when conditions are right. So all in all, emerging markets this year are looking more attractive than they have been in the past. There is a benefit from rates going down. So particularly we like Latin America, Brazil and Mexico. We do think that as growth picks up relative to developed markets, there'll be more opportunities. And one area we really particularly like is ASEAN region, particularly Indonesia. And finally, we do see at some stage during the year, better prospects for the Chinese stock market, which is something that's been out of favor. So all in all, patience for the beginning of the year, but we do see good returns in emerging markets along the way.